liquidity providers have previously assessed there may be sufficient longs to accept cash settlement, say, roundabout. Remember we talked about it, plus or minus $230. Originally, it was 140, then undoubtedly moved higher, and it is moving higher all the time. However, while we've done some reports of some backdoor deals actually being done to cash settle these COMEX exchange for physical bets, last week's critical minerals price floor system has raised the ante significantly. And while price floors are seeking to insulate Western producers, refiners, investors from the historical Chinese oversupply tactics that we've witnessed over the years, which have for decades and decades have enabled China to manipulate Western leverage futures prices lower, enabling them to buy up thousands of tons of synthetically underpriced Western silver and convert it into physical in their exchanges. The situation has now reversed. China has sucked in sufficient global liquidity to be able to set the global silver price. And as much as it did when it opened up gold, the gold price opened up gold to its people in 2010, it has for some time been openly encouraging its people to also buy silver, which will appreciate by way, as with gold, of a rising managed silver price, not by interest or anything else, simply because the price will rise. Into a synthetically derived growing 8th consecutive year of supply deficits, China has now gained sufficient physical market liquidity and has the necessary conduits to control a very tightly regulated global silver price. Now, this real supply-demand price stability facilitates the movement of global silver into onshore and Western-facing free trade zone corridors, attracting supply while depleting what remains of the LPMCL CME remaining unallocated silver. So in essence, the two daily SGE silver fixes represent a real physically determined supply-demand price that attracts global producers, refiners, institutional investors, and that kind of demand, which is instrumental in ensuring the efficient redistribution of physical silver to meet global demand. Far better adapted to evolving supply-demand market conditions than the COMEX ever was. Now, producers play a crucial role in responding to these shifting physical silver market dynamics. Now, as price floors lead to higher real physically settled prices, producers and refiners are incentivized to engage in global settlements that truly reflect a collateralizable benchmark price. Their participation, what it does is help facilitate the movement of physical silver supply into Western-facing free trade zone corridors, which are attracting physical silver and draining the West of its remaining unallocated silver. This is history in the making. We are witnessing the end of 50 years of gold and silver price suppression. Now, either the COMEX is going to default or have to raise borrowing costs high enough to reflect a deliverable price if called on. Something is broken. In fact, in the bigger picture, there are so many bullish drivers that point to strong silver demand into an ever deepening supply deficit, which will in turn raise the offer price to cash settle delivery obligations, perhaps could be closer to $300. But this won't be a slow process. This is the point. When it happens, it'll be fast and it will not be driven by rinsable speculators. So into a deepening structural deficit that now incorporates global export bans. The US imports actually 64%. Think about it. Imports 64% of all its silver for AI and defense to add to its strategic critical minerals stockpile. And that's militarily as well required. They don't have it. They're having to import it. It means buying physical silver. And because gold and silver prices are being set in the very liquid physical settled onshore and western-facing free trade zone gold and silver trade and vaulting corridors, that will be the actual price, not a derivative price. And tight supply silver will flow, obviously, to its highest offer. So if the COMEX is pricing it under and there's a supply deficit, and literally, where do you think that silver is going to end up? And you just have to look at the massive drop in Shanghai silver inventories to realize everything on offer globally will be competed for. So as we assessed last time, $80 was where our liquidity providers reported that the commercials exposed to delivery obligations had moved 1-to-1 to take the long side of these naked short, we call them wrong at both ends, momentums, control 80% of the open interest, and they just, there's no rationale, they chase momentum, and then they're wrong at both ends, clearly. You can't be right at both ends, but you're right in the middle. So these momentums, as I say, because they control 80% of the COMEX open interest, kind of confuse the issue. And these, especially as the media, the mainstream media, they were very noisily, and obviously to talk their own book, very noisily, they were targeting the low 40s for silver. And so really, as far as they're concerned, it's a dot on the screen, means nothing to them, whether it's physical, there's no physical side to the, as far as they're concerned. So I also do the same in the oil markets. It's just momentum. It confuses the issue. So while offshore retail demand was actually absent during the SGE holiday, remember, it was just coming up the last time when we recorded last time, it was yet to come. Now it's, and of course, they're back. But essentially, during the SGE holiday, the PBOC, as we said, they will not be absent, and they weren't. And the thin liquidity, $8 COMEX sell-off below $80 to $72 was jumped on by Asian buyers paying well over $100 real physical delivery asking price. So the real physical price was really significantly, literally $30 odd above where the COMEX positions were started to get squared. And guess who was on the long side of that? So what they don't get is that these price dislocations place the COMEX in the crosshairs for a backdoor loadout, cheap enough to fly this silver out of the LBMA CME, sticky little fingers, gone, poof, away. Now, the scramble by the house to short cover into this widening gap affirmed that silver had reached an absolute inflection point. This is good news to know this stuff, where the historically bearishly skewed swap dealers exposed to accruing delivery obligations that they couldn't fulfill were forced to bend the knee to the 100% physically settled onshore SGE and the free trade zone western-facing exchanges. However, a little too late. The damage caused by the paper market overshoot had spilled blood into the water, and the sharks are feeding. There's no going back from this, despite the fact that the house has been offering very large cash premiums to settle or roll over the expiring March contract that is being demanded for delivery and is way short of what is supposed to be there for these bets to have been made against it. So despite the fact that the house has been offering very large cash premiums to settle or roll this contract, so that it can kick the can down the road again into the May contract, which is the next contract that it rolls into. Trouble is, as of today, far too few have chosen to cash settle. Now, and as can be seen by the impossible to hide published, lopsided, unbacked silver warrants that are floating around, which are being demanded for physical loadouts, literally, we're talking in 2 days, which is Friday, when you will have this episode published. We're recording this on Wednesday. So basically, these physical low does are going to occur